All right, guys, thank you to everyone who's watched the past two videos. I've had some really good response from it. Some great questions resulted from it, so I'm excited to keep this going. For part 3, I felt I should talk about something that's clearly on everyone's mind. It's on the news every day: interest rates. How does this affect your payment, and are there other options? Obviously, interest rates have gone up, and they've gone up quickly. As per Freddie Mac, the average interest rate 3 months ago was 3.85. Today, it's 5.81. That equates to roughly $570 of purchasing power every month. So what are your options in today's market? So there's a product out there that I don't think is being talked about enough. It's called an ARM, or an adjustable rate mortgage. What it does is it sets your mortgage rate for a set period of time, and then it adjusts thereafter. So as an example, today I'm going to use a 10-year ARM where it's set for the first 10 years, and then it adjusts every 6 months thereafter to paint a picture. So let's look at an example. Let's say you're looking at a $600,000 house with $14,000 property taxes at 5.81%, the average today as per Freddie Mac. Your monthly payment would be $39.86 a month. Now let's look at that exact same house, but let's look at the interest rate that's being advertised for adjustable rate mortgages today. $600,000 still, $14,000 property taxes, but you could get an interest rate as low as 4.325. Now your monthly payment is $35.49 a month. That's a savings of $437 every single month. Let's look at it another way. If you utilize that adjustable rate mortgage at 4.325, how much house could you afford to have the same payment as at 5.81%? The answer is $705,000. You could buy a $705,000 house with $14,000 in property taxes, and your monthly payment would be the same if you bought a $600,000 house at $14,000 property taxes at the conventional fixed rate of 5.81%. So then the number one question I get when I bring up adjustable rate mortgages is, what do I do after 10 years? Now, the reality is that the average home ownership in the New York metro area is 9.8 years. People sell their homes every 9.8 years. And the average length of a mortgage held in America is also under 10 years. So statistically, there's a good chance that you're either going to refi, whether you need to do cash out, you want to do improvements, you're paying off student loans, whatever it may be, or statistically, there's a good chance you're going to sell within those 10 years as well. So this option may not be for everyone, but it's good to know what your options are. If this is the difference between getting into that home you love and not, then my suggestion would be to explore these adjustable rate mortgages because they absolutely can be beneficial. So as usual, probably threw a lot at you, and I guarantee I'm going to have questions coming my way, but that's good. I love that. As always, continue to ask questions. Let me know if you want any further information about these adjustable rate mortgages. I can point you in the right direction. If you have any questions at all, obviously don't hesitate to reach out. Thank you again for watching this, and I hope you have a great day.